Come on.
Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Wednesday, October 14th, 2020. And our top story today, we'll be taking a much closer look at pooled employer plans, better known as PEPs. Well, joining me now to discuss this and a lot more is the head of DC and financial wellness research, and also the head of DC and financial wellness, Neil Lloyd and Leanna Magner of Mercer. Neil, Leanna, thank you so much for joining us on the program this morning.
Hi, Jeff.
Thank you. Thanks for having us.
Absolutely. Great to talk with you. So, Leanna, I want to come to you because pooled employer plans are something relatively new. They're part of the Secure Act, and many folks listening to this program right now may not know what they are. So would you mind just starting off with a basic definition of what PEPs are?
Sure. So a pooled employer plan is a 401k plan that allows employers across multiple industries and sizes to pool together into one plan to potentially reduce plan costs, decrease administrative and fiduciary burdens, and expand retirement plan access by offering retirement benefits to their employees.
Yeah, thank you, Leanna. And Neil, how did we get here? I mentioned the Secure Act, but this is really in a long line. There are 70 million people in this country who do not have access to a workplace retirement plan. How did we arrive at this point where we're going to have PEPs?
Yeah, I mean, as you say, one of the biggest issues in the country is a lot of people not having savings and not having a natural way to save. So we have seen things like some of the state plans come forward, which is a positive start. But I think the feeling is of offering pooled employer plans as well, that's a way for smaller employers to offer a plan more easily. We've seen that if you look at the statistics, a high proportion of those who actually don't have plans at the moment are with smaller employers. So I think this will help to encourage coverage. But certainly if other initiatives come in as well, then I think they will actually help to encourage coverage even more and to get more access for Americans as well.
Yeah, and Neil, in terms of who this is for, I think you alluded to it. I mean, these are typically for smaller employers, but who from your perspective and Leanna's perspective would be an organization that would be interested in something like this?
Do you want to shoot, Leanna?
Sure. So first, I think one of the key objectives of the Secure Act and the rationale for offering PEPs was to be able to provide access to retirement plans for those who don't already have access. Mm-hmm. So to some degree, it's geared toward employers who don't already sponsor a plan. So this would be an easy way for them to be able to offer the benefit to their employees and not have to act as that plan sponsor. I think also it may be attractive to plans that already exist today, but those who are looking to offload some of their fiduciary and administrative burden, and also for small plans who don't have their own economies of scale, joining a PEP can provide for those economies of scales of pooled plans to help reduce costs as well.
And Leanna, what types of firms would offer a PEP? Is it something that a human resources consulting firm would offer? Is it something that an asset manager or record keeper or other employer would sponsor? Who is looking at this and saying, hey, this is a great opportunity to help other people, but also streamline the way we do fiduciary governance?
I think we're going to see a variety of different types of organizations becoming pooled plan providers. Of course, I think we will see record keepers, insurance companies, some consulting firms, HR consulting firms. We may also see banks, payroll providers, and even third-party administrators.
And Neil, we've received a lot of guidance, and certainly a lot of what we were talking about at the end of the year, Secure Act has been kind of hijacked by the CARES Act and dealing with the pandemic. But I got to think that there's a lot of regulatory aspects of this that the Department of Labor and other federal entities are looking to install here.
Yes, and unfortunately, we haven't seen a lot of that yet, and that's one of the challenges that we have. So the Department of Labor has done two things. I mean, it did issue an RFI, and the RFI was to get industry input on the issues the regulation was to cover. So to get some feedback on, I mean, things like, if you're a record keeper, it's difficult to offer a PEP if you're going to potentially appoint yourself as a record keeper without getting some sort of prohibited transaction relief. And that was the same with sort of investment managers and people like that as well. So that was an issue that was asked about. But what hasn't happened since then is the actual guidelines or regulations haven't come out. The second thing was the DOL did do was it issued an initial proposal in terms of registration guidelines. I mean, they weren't that significant, so I think that's fine, but that still needs to be finalized. But there's a challenge. I mean, PEPs in theory should be in place by the 1st of January. Generally, when things like the regulations get issued, there's a commentary period, there's then a response, and eventually they get issued. And we have a couple of complications. We have an election coming up in a month's time.
You don't say.
So things could get a little bit sort of challenging, and we do know there's some political sort of tension about some of these issues because when the initial RFI came out, the DOL was asking what relief do various providers potentially need, and Richard Neal, the chairman of the House Ways and Means Committee, he actually wrote a letter in saying that he didn't feel that there was any relief that was necessary. So we're going to have to see how things play out, but one of the difficulties with offering a PEP on 1st of January is not knowing exactly what the regulations are going to say, and we can guess they'll be okay, but it could cause some complications.
And last question for the segment, I'm going to ask you first, Neil, and then we'll bring Leanna in. Neil, you do a lot of research on financial wellness. What's the potential impact here based on some of the research studies that you and Mercer have done on PEPs? Are we going to see these 70 million people who are not uninsured, but they're not part of an employer-based retirement plan? Are they just all of a sudden we're going to see this massive groundswell of plans starting up? What's your sense on what the impact of financial wellness will be?
Well, I think if we talk about financial wellness, I think is a much broader issue. But if we just talk about PEPs coming out, I think that it's probably going to start quite slowly. It often works that way. So there's going to be a little bit of uncertainty about pooled employer plans initially. But we can talk a little bit more later about some of the international trends. But I think initially we're going to see it move quite slowly, and I would be surprised to see lots and lots of new plans suddenly go and sign up. But it will happen slowly over time. So that's a positive thing in terms of retirement readiness.
Yeah, and Lee, go ahead, Neil. I'm sorry.
No, and I think all I would say is I think when we look back, I think we're going to see us have a much bigger impact, but it may start slowly.
And Leanna, from your perspective, as someone who's dealing with employers of all sizes, all types, I mean, do you really see this as an opportunity for in the short term where we're just going to see this groundswell of support for these types of things, or are some of the things Neil's laying out going to maybe stymie some of the early adoption?
Well, I think we're in an environment today where obviously the DC plan marketplace is quite litigious. So we've seen sort of less innovation in the DC space. We've seen plan sponsors not necessarily wanting to be first movers for innovation. So, I think it'll start with those plan sponsors who are, maybe going through resource constraints during this particular period. They don't have time to focus on their retirement plan, and this provides an opportunity for them to take a look at their governance model and think about what types of responsibilities do they want to maintain fiduciary responsibility for, and what do they want to offload, and whether that results in those plans joining a PEP or not. I think we will see an increase in outsourced solutions. Whether that's all the way to a PEP, we'll have to see, but I think it will increase the interest in other outsourced solutions like, 338 investment management versus a full bundled plan.
Right. Well, we're going to take a quick break. When we come back, we're going to talk about what's going on internationally, and then also what implementation potentially could look like. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive Fibrex composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to Neil Lloyd and Leanna Magner of the human resources consulting firm, Mercer. Neil, Leanna, thank you so much for staying with us this morning.
Sure, Jeff. It's great to be here.
So, Neil, as I alluded to going to the commercial break, internationally, there's a lot happening in this space, and I think we can probably look to the United Kingdom and things going on there as a really good barometer of how multiple and pooled employer plans can be deployed. Would you agree?
Yeah, I think it's quite interesting not just to focus on the UK. The UK experience is we can talk about that. But also we've seen, Australia I think is a bit different. But Australia, we've seen a situation where single employer plans have basically disappeared. It's a really extreme situation, but maybe led by particular factors. I also like to talk about South Africa as well. And I lived in South Africa for 24 years, so forgive me for that sort of focus. But it's another interesting example where there's a blend of sort of pooled employer plans and single employer plans. But But maybe just to give an idea of the UK, I mean, what's really been interesting in the UK is the UK has master trusts. And what's been really interesting there is it's moved incredibly quickly over around 5 years. And we were talking internally, and they mentioned to us that probably about 40% of the business today is, well, 40% of the market is now master trust, and it's getting close to 50% quite quickly. And they actually mentioned that I think 90% of new contributions were going into master trusts. What's also been interesting there is that the focus has been on the participants as well. I mean, the master trusts have led in terms of investing a lot of money in the participant experience. And I parallel with that with South Africa. And South Africa, I was actually there back in the late 90s when this really, really took off. So it's been going on for a lot longer. And probably there, it's developed into a market where, say, 40% of the market is what they call umbrella plans, which is similar to pooled employer plans.
Mm-hmm.
And there's another balance of single employer and a whole set of union negotiated plans. So it's a real balance. But again, what we saw there, and I think that's an interesting example for the US, is that these plans started very simple. The presumption was that small employers would be the ones leading the way. And I can remember that when I was there, almost our first client who said, yes, they wanted to do this, was one of our largest clients. And with hindsight, we probably weren't quite ready for that, but it was quite interesting that they came up and said, they said the comment, I want my people to be focusing on selling furniture. I don't want them to be spending all the time managing a retirement plan, and they went down that direction. So it's been a bit of a blend, but again, what I would say that it did start simple, and what was nice was to see how it evolved as a really leading edge and actually leading innovation in those countries. And we've seen that in both the UK and South Africa. I think that's a very positive sign for what can transpire in the US.
Yeah, I mean, there clearly, if someone has done it before, there's a lot of lessons here, Leanna. When it comes to implementation, what are some of the things that, and we don't have it all kind of worked out because we don't know all the regulatory aspects of this, as we talked about in the first segment. But when we talk about implementation, there's things like plan documents, there's investment setup. How are you guiding, or how will you guide potential clients in a pooled employer environment?
Sure. So I think the one piece that's really key to keep in mind is that the plan sponsor is still responsible for selecting that pooled employer plan. So there are certain kind of best practices that we think are important to review, and that is just the overall structure. How are the fees structured? Are they transparent? Is it a bundled fee? Are there separate fees for the various components of the solution? Does the pooled plan provider have any conflicts of interest? And if there are conflicts of interest, they ensure that they manage those conflicts appropriately. And then I think there's also assessing the investment options and the role that the provider is playing in terms of selection and monitoring of investment options. You can either have a 338 investment manager role, or you can have someone serve in an advisory capacity. So it's important to understand what role is being played, what investment vehicles are being offered, and are the fees for those investment options competitive in the marketplace versus similar strategies.
You make a really good point. You bring up fees, and we kind of live in the retirement world in a very litigious environment. We talked about that, I think, in the first segment of the show. Is this an area that plan sponsors really, they already have to do a lot of due diligence, but also take very good notes, make sure that they explain the rationale for the decisions? Is this another example that as you're making this decision as an employer, as a fiduciary, as a committee, you're going to have to take very, very detailed notes here to make sure that you can justify the decisions you made?
I would say, governance is really key in the DC marketplace, and it never hurts to have stronger governance versus weaker governance. And given that the plan sponsors are a fiduciary for selecting that pooled employer plan, it makes sense to follow a strong framework and to document that process as appropriate.
Yeah. And yeah, I want to bring you in on that part of the conversation as well, because there's so much going on from a litigation point of view. And that could actually work against a plan sponsor in some cases. Not that they've done anything wrong, but it just creates a little bit of fear and anxiety. And, and this is obviously a very important topic in terms of getting more and more coverage.
Yes, and I think one thing I would certainly recommend to plan sponsors is to, as Leanna said, so do the homework, but it's also look at some of the fine print. And I'll give you an example. I think I think it's true that pooled employer plans will actually provide more fiduciary protection, more protection against litigation, but they won't remove it. But one example, Leanna mentioned a 338 investment manager. I think people going into this assume the pool plan provider is taking responsibility for investment decisions, but that isn't necessarily always the case. And in fact, if they don't assign a 338 investment manager, the plan sponsor is still responsible for investment decisions. And so I think that's a critical issue to make sure you actually understand. And I'll give a parallel. Probably about 5 or 6 years ago, the GAO wrote a report on the managed account market. And they made the point that some managed account providers offered 338 protection and some others didn't. And I think we've actually seen that we're dealing with clients more recently. When we talk to them through cases, we actually go and find out that actually they don't have that protection and they thought they did. So I think it's a case of you do your due diligence, you ask all the questions that Leanna went through, but also do your homework as well to make sure that you are getting the protection, because yeah, it's a tough time for plan sponsors, and no one likes litigation.
No, I don't think the only ones who like them are the attorneys, clearly. Leanna, last question here. RFIs, RFPs are a big part of selecting providers. I would think that the RFP process could get a little bit more complicated, more levels of questions. We already got a ton of questions now on administration, but also cybersecurity. Would you think that those RFPs grow a little bit more in length as this process gets implemented?
I think they certainly will, because searching for a pooled employer plan involves more than just administration. So if you kind of equate it to doing an RFP for that, so it's going to be a broader RFP with various different components of questions in different areas. I think we may see an opportunity in the marketplace here for those kind of third-party search firms to assist plan sponsors in selecting pooled employer plans.
Well, thank you, Neil. Thank you, Leanna, for sharing your insight and perspective.
Thank you.
Thanks for having me. Thanks, Jeff.
Well, that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to, then drop us a line. And don't forget, for all the news in retirement, markets, technology, personal finance, so much more, check out our daily newsletter, The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.